ECB is set to hold rates steady today, resisting calls for a cut as policymakers meet in Frankfurt. Instead, Jean-Claude Trichet may look to more liquidity to fight the deepening crisis. Now, banks are struggling as money markets tighten, and boosting cash supply could be a way out. Well, the rates decision comes at 1:45 London time, followed by a statement from Trichet. He may say that the threat from inflation has eased while risks to the recovery increased. The Bank of England may also mull more stimulus today, with policymakers set to keep the benchmark interest rate on hold. It's still at 0.5%, which is more than 2 years after it first slashed it to that record low. The bank is expected to set aside inflation concerns and risks as the recovery threatens to unravel. That decision due at noon, 45 minutes before the ECB decision. Well, with me now is Paul Donovan, the Managing Director of Global Economics at UBS. So, Paul, gosh, since you were here last time, things in the Eurozone have gotten worse. What should Jean-Claude Trichet be doing today?
Well, what he should be doing is cutting interest rates and urging politicians to get their act together. I don't think he's going to do either of those things. He might make a couple of hints to politicians, but I think today is going to be fairly bland. I think, are not going to see any interest rate change. We might get an indication that they're going to keep rates steady as we go forwards. That would at least be something. Get them off the tightening track. On the liquidity side, this is somewhat uncertain, to be perfectly honest. There isn't actually a liquidity problem as such at the moment. Banks can borrow money. It's just they can't borrow money from the market. They can only borrow it from the ECB. So the problem is more the solvency of banks and concerns about the sovereign crisis and its impact on banks, rather than the amount of money in the system itself.
So what might he say about liquidity today?
Well, I think he will talk about stresses in the banking system, about the need for stability in government bond markets. And I think that's going to be quite a key focus, because the bond markets are an area where we've had a lot of volatility, where we've seen damage being done to banks which own the bonds. So I think if he's saying, well, actually we need to make sure that governments run the right fiscal policies and we need to make sure there aren't irrational moves in bond markets, that could be an indication of ongoing support.
That he's going to keep buying bonds.
Exactly.
Now, when it comes to interest rates, is he just being stubborn? Why won't he cut?
Well, he won't cut because parts of the Eurozone don't need a cut. Parts of the Eurozone probably need an increase in interest rates, including perhaps Germany, whereas other parts of the Eurozone need an interest rate cut. This is, of course, the fundamental problem with the euro. It does not work. We've been saying this for 15 years. And poor Trichet, I mean, one does feel a twinge of sympathy for him every now and again. He's confronted with an impossible situation. Does he raise rates because Germany needs an interest rate increase, or does he cut rates because that's what Ireland really needs? And that's why I think we're getting this inaction from the ECB.
We're going to talk about your statement that the euro doesn't work in our next little segment with you. But first, let's finish talking about rate decisions. We've also got the UK, the Bank of England here, deciding today. And, of course, they've had more of an issue with inflation here than Europe has. So what's Mervyn King going to do today? Well,
in one sense, we've had more of an issue with inflation if you look at the headline numbers. But, in fact, UK inflation is about the same as Europe when you strip away the one-off effects like the tax increase. The VAT sales tax increase. Now, the Bank of England, unlike, I have to say, the ECB, is run by economists, which is a good thing. And economists, of course, take a very sensible view, and they say, well, look, this is a one-off effect. We can look through that. We know what happens to inflation next year. The last inflation report had inflation below target within 2 years. So the Bank of England, I think, is not going to be too concerned about inflation. At the same time, I don't think we're going to get action today. I think the bank probably wants to see another inflation report confirming the view that inflation is definitely coming on the downside as we go through the next 2 years before they would consider actually taking action. Maybe one or two dissents this meeting, but I don't think we get a vote.
We know the British government is keen for them to take an active approach. Okay, Paul Donovan, the Managing Director of Global Economics at UBS, is still with us, so let's talk about the European debt crisis. First of all, with Italy, we saw that the cost of insuring Italy's debt actually rose to higher than the cost of insuring Spanish debt for the first time in a couple of years. So that indicates that it's now really the central focus for investors in terms of being the eye of the storm. So my question to you is, how worried should we be about Italy? Is it going to be the next in line for a bailout?
No, I don't think so. Italy is basically all right, that it's got very long duration debt. So unlike Spain, where the debt's very short duration, it can't really be held to ransom by the markets. I mean, it needs to get its budget deficit under control, and the austerity plan is an important step forwards. But basically, if bond yields go up for 6 months, Italy doesn't care. Bond yields go up for 6 months in Spain, it's a national disaster.
Right.
So that's the key difference. Italy has got a little bit more time, it can manoeuvre itself a lot easier. And frankly, if there is any country on the planet that knows how to deal with low growth and high debt, it's Italy, because they've had 30 years of practice of doing this.
Right.
They know what they're doing when they're managing their debt.
Now, you say that the euro does not work. It shouldn't exist in its current form, yet you also say that there's almost zero probability of a breakup.
Yep.
How can it be both?
Well, it doesn't work in its current form with its current membership. So you've got two choices. Either you change the membership, which is the breakup, or you change the form. Changing the membership, having a breakup, there's this casual, oh, we could expel the Greeks. Or,
Like it'd be no problem.
Yeah, but it won't be no problem. I mean, this is the whole point of the Eurozone. It's not a fixed exchange rate mechanism. It's a monetary union. I mean, it would be like America expelling Texas. And as a result, the consequences of a breakup are very, very severe in terms of disruption to economies, in terms of civil disorder, in terms of really major political threats, huge costs. So what you've got to do is change the structure to make it work. Fiscal confederation is where you've got to go. If you are having a monetary union which doesn't work properly, you've got to compensate for its failings with a fiscal confederation.
Is there political will for that, though? I mean, Germans are not too pleased about having to spend their taxpayer money on more Europeans.
Well, we've been edging slowly, very slowly towards this, and I'm not underestimating the cost. This is going to be painful. It's going to be really difficult to do, but we're edging in that direction at the moment. So what I think we're going to see is a gradual process over the next 5 years which gets us to some kind of confederation. And the whole point is we've got to move the debate on. Politicians are having this very childish debate about we won't bail out the Greek government. Well, don't bail out the Greek government. Let them default twice.
Well, but then you're going to be bailing out your own banks if you do that.
What you need to do is bail out the Greek economy. Bail out economic regions that need assistance within the Eurozone. Forget all this bailing out governments nonsense. We need to bail out economies. We need to have a sensible adult debate about what fiscal union actually means. And it doesn't mean you keep giving money to the Greek government. What it means is you have a common unemployment benefit across the Eurozone, some common taxation to a limited extent.
Yeah. Okay, Paul Donovan, we have to leave it there. Thanks very much, Paul Donovan of UBS.